When it comes to saving money on taxes, the truth is it really depends on what you invest in to get tax benefits. A lot of people will come to me during tax season and they'll say, here's all of our information, what can we do to save money on taxes? By that time, it's usually far too late. So here are some proactive tax strategies that you can implement this year, before the year is over. The earlier you implement them, the better. This will be a mix of things. We'll go through things that will apply to people with investment income, such as from the sale of stocks, things that apply to people with W-2 income, things that apply to people with just business income. So there's a number of strategies here that we'll go through. We'll touch on each of them and go through those. So first off, one of the most powerful tax saving strategies around right now is called the short-term rental. You can call it a loophole or an exception or something like that. But basically the problem is that when you have a rental property and you have someone that's renting that property and they're on, say, like a month-to-month lease or an annual lease, that's considered a long-term rental. And any losses that come from that are considered to be passive, which means that they're not deductible unless you have passive income, which most people don't, so they end up not being deductible. The losses just carry forward to future years. However, those same rules do not apply to short-term rentals as long as it's set up correctly. A short-term rental is defined as any rental that has an average rental period of 7 days or less. So when you think about that, you think about like Airbnb properties where somebody's usually renting it for under a week, like a few days at a time. And so that's a short-term rental. As long as you actively participate in that, it is not considered to be passive, and any losses that are generated from that activity can offset any type of income. It can offset W-2 income, it can offset investment income, capital gains, business income. Any type of income you have, the short-term rental losses can offset that, especially if you take what's called a cost segregation study against that short-term rental. That can generate a huge loss in 1 year. We had a number of clients do a short-term rental strategy during this last tax season. They saved anywhere from $20,000 up to $100,000 or more with a short-term rental tax strategy. So they're very powerful and work really well. We'll have another video that goes into more depth on short-term rentals and how those qualify. But for now, that's one of our strategies that we look at. Another one is oil and gas investments. So you could put your money into, say, the stock market. You could put your money into a bank account, into a savings account. You could put your money into municipal bonds or treasuries. There's a number of places that you can invest your money. When you put your money into those investments, you do not get a tax deduction for the money that you put in. It's just considered an investment, and when you get your money back out, it's considered non-taxable to you. However, there are things that you can put your money into and actually get a deduction. Oil and gas investments happen to be one of those things. If you were to invest, say, $100,000 in an oil and gas investment, generally you're getting anywhere from 80 to a 90% deduction based on that. So $100,000 into oil and gas, you're going to get an $80,000 to $90,000 deduction on that investment immediately when you put that money in. Now that helps to offset, again, any type of income that you have on your return. It can offset W-2 income, business income, investment income, anything like that. And so that makes oil and gas investments a really powerful tax strategy because it can apply to anyone. And oil and gas investments are deemed to be an active if you're investing in as an active investor in there. It's called a working interest in an oil and gas. Then you can take losses against any type of income. So oil and gas is another one. I should go back and say that short-term rentals, that's another one that you can actually get a deduction based on how much you put in, and even more than what you put in, right? Because let's say that you buy a $500,000 property, you have to put 10% down, so that's $50,000 that you put down. You get a $450,000 loan to buy that property. You can actually deduct more than you put in because that loan that you get back gives you what's called basis and enables you to take even a bigger loss than the money you put in. That's what makes short-term rentals extremely powerful because you get a bigger deduction than what you put in. I often call that the Donald Trump tax plan. Everybody wants to say, I want to pay no taxes like Donald Trump. Well, Donald Trump's able to put less money into an investment than he gets a tax deduction back. Therefore, he effectively can zero out his tax by paying far less than what that tax number is. So yeah, short-term rentals, oil and gas. Another one that's really powerful is qualified opportunity zones. So this was set up in the 2017 Tax Cuts and Jobs Act. A lot of these will expire in 2027 and become taxable, so the time horizon is very short, unless there is an extension made on these during the 2025 when all during 2025 with the new administration with Trump administration and everything, it's expected that a lot of the tax provisions are going to be extended. So we'll see what happens to qualified opportunity zones, if they're extended or what happens. Right now, people that invest in those, any tax savings that they get is expected to hit in 2027. But the idea there was that if you had a large capital gain, this only applies to capital gains. So let's say that you had a large capital gain, any amount of that gain that you put into a qualified opportunity zone, the tax was deferred. So let's say that you had a $500,000 gain and you put $200,000 into a qualified opportunity zone. Well, you were not taxed on the $200,000 you put in that qualified opportunity zone. It immediately just took that off of your tax bill and kick that down the road to 2027 or maybe longer, depending on what happens with this year. Which reminds me, so if you're not subscribed to this channel, subscribe, because there's going to be a lot of tax changes coming up, and we'll make sure to cover all of those as they come. So qualified opportunity zones. One that is perhaps more, I guess, controversial or prone to risk is one that's called conservation easements. These were attacked heavily by the IRS and still are being attacked by them because they were abused, terribly abused. They were put into what's called a syndication so that people could just put money in and get this deduction back. The IRS attacked those, so we don't go for these syndicated conservation easements. Conservation easements are still good and are still valid in the tax law and are still a great way to save money on taxes if they're set up correctly. A conservation easement is basically that you have a piece of land that you are going to conserve. You're going to say, this piece of land we're not going to develop, we're going to conserve it. Well, you get a charitable deduction for doing that, and then you just save that land and keep it. The problem was, again, with these syndicated ones, that people would put these land into like a partnership and they say, hey, come buy into this partnership and you'll get this deduction and you don't have to do much about it. And so that's what the IRS didn't like. But if you've got a piece of land that you want to conserve, then a conservation easement is a great way to go to save money on taxes, and it's fully compliant with the tax law. Another status that you could look at is the real estate professional status. This is actually the true Donald Trump tax plan, is he's a real estate professional. And when you're a real estate professional, earlier in the video we talked about that if you have a long-term rental that is considered to be passive, well, that doesn't apply if you are a real estate professional. The real estate professional status, we'll have a full video on what that is and how to attain that and go through that in more detail, so make sure to subscribe to get that video when it comes out. But a real estate professional, it's hard to get there because the hardest part of that is that you have to spend over half of your working hours in a real estate trader business. Now, I am a CPA. Most of the time I'm doing taxes, doing tax planning, preparing tax returns. In any given week, I'm easily spending 40 plus hours doing that. During tax season, it can be like 100 plus hours. So for me, a real estate professional status is probably beyond what I can do, because let's say I only worked 40 hours a week in doing the CPA work. Well, I would have to work 40 hours and a minute, 1 minute longer every week doing real estate trades or businesses. Now, if I were to maybe retire from the CPA side or cut that back or not be as working that, let's say I could cut my hours back to 20 hours a week in it, then I would only have to spend like 20 hours plus a minute, or something bit longer than doing the CPA work, doing the real estate, and then that would allow me to qualify for the real estate professional status. So that's the reason why most people have a hard time qualifying for that status unless their full-time job or career is in real estate, such as a real estate agent or real estate broker or something to do with real estate. It's difficult to get there. But for those that have that status, it's a hugely powerful thing, because now you don't have to deal with just short-term rentals to get the write-offs from real estate. You can do the long-term rentals and get the write-offs. You can do cost segregation studies. You can do 1031 exchanges. You can do all sorts of things with those that help to either completely eliminate tax, reduce tax, defer tax. All the strategies are really around real estate, and real estate professionals get all of those benefits. So that's another one. And then finally, we'll close off with another one that can be controversial, one that the IRS has attacked, but again, if it's done correctly, it's completely legitimate and works really well. The problem is that people just abused it, and this is one that's called captive insurance. This is one for business owners that are making in the multiple millions usually in order for this strategy to work and work well. It can be an expensive strategy to set up. It takes a lot of cash. But basically a captive insurance means that you have some kind of a risk in your business that you need to insure. And so rather than going and buying a policy from an insurance company, you actually self-insure that through your own captive insurance. And so you take, you figure out like what kind of risk you have. And the reason why these were abused was because people were coming up with phony risks like, I'm going to insure against, in case my kid gets kidnapped, or I'm going to insure against like an alien invasion or something, something that was just so remote that it would like never happen, right? So to set them up right, you need to have like a qualified insurance person like really look at it, come up with what would be a really valid risk that could potentially happen. We just went through pandemic, so that has now become, I'd say before pandemic, insuring against a pandemic was probably like a long shot because there's hardly ever a pandemic. Well, now we just had one, so that one was a huge business risk for all businesses. Now, I'm not saying that is an insurable risk. You've got to talk to an insurance professional and kind of go through that. But I'm just saying that's probably a little more likely of a risk than it was a few years ago. So yeah, captive insurance, one that you basically insure yourself, you pay the premiums, the business will take the premiums, it will pay it to your captive insurance company. The business gets a full deduction for the premium that's being paid, and then that money just goes and sits in this captive insurance company and waits for some kind of a settlement or a payout that may come in the future. Then if that risk never materializes at some point in the future, then you're able to take those premiums back, and when they come back, they actually come back as capital gains rather than ordinary income. So you get a deduction at ordinary income today, the money sits there pretty much tax-free, and then when it comes back, you pay tax on it, but at capital gains rates, which would be a much lower tax rate than ordinary tax rate. And so that's how the captives would work. So there's a few ideas, again, some of them that we'll flesh out more fully in some other videos, but those are some great ways to help anybody save money on taxes, whether business owner, non-business owner, and things like that. So if you're would like more updates on this, make sure that you subscribe to our channel, and also go to taxtutor.com where you can subscribe to our newsletter.